This is part 2 of topic 6, the microeconomics of financial markets. Now you'll recall in part 1 of this topic I described how there are different debt markets, in particular short-term and long-term debt markets, and in those debt markets there are different interest rates, short-term and long-term interest rates. Now to actually facilitate the lending in those markets, that is the transfer of money from the lender to the borrower, there needs to be some sort of financial instrument or debt instrument, and it's those instruments which facilitate the transfer of money that we're going to learn about in this particular topic. Now with short-term debt and long-term debt markets, the instruments that actually facilitate the borrowing and lending are quite different. So with short-term debt markets, typically we're talking about discount securities. So discount securities are typically issued in these markets. Now discount security, typically they are issued for 12 months or less, and let's just consider the example of $100,000 security. Now let's just imagine that this security is also issued for just 3 months. Now that means that there would be a transfer of money from the lender to the borrower for 3 months, and at the end of the 3 months either a new security is issued or the debt is repaid. Now because we're talking about 3 months here, 3 months is not long enough to actually warrant an interest payment. So because of the short period of the borrowing, the way that these markets actually work is that a security with a face value of $100,000 will be issued. Now the face values can be different values depending upon the needs of the borrower. However, let's just consider a $100,000 security. That may be issued for $98,438.37. So the buyer of that security, that is the lender of the money, will pay $98,438.37. Then in 3 months they will redeem that discount security and receive $100,000 back. So the return that is earned is the difference between what you pay for the security, the $98,438.37, and the $100,000 that you redeem it for. So this person would actually earn, if we do the quick calculation here, $1,561.63 for an initial investment of $98,438.37 for a period of 3 months. So that return over that initial investment, you could actually convert that to an annualized amount. Now with short-term debt there are basically two main types: promissory notes and commercial bills. I'll let you do a little bit of reading in your own time, a little bit of research to understand the differences between these two forms of money market securities or short-term debt. But just quickly, with a promissory note, those notes are issued by very high credit rated governments or companies. So with a promissory note there is no intermediary between the borrower and the lender, and that occurs because the lender has such a good credit rating that they don't need their debt guaranteed. However, with a commercial bill, those bills are typically issued by companies that have lower credit ratings, and the idea there being is that there is a financial institution, maybe some sort of investment bank, in between the borrower and the lender, and for a fee that financial institution guarantees that the lender will actually get their money back. Okay, and that's relevant because the borrower in a commercial bill setting doesn't have as good a credit rating. Okay, next slide. This shows you how a yield is calculated in short-term debt markets. So this is a discount security. It's got a face value of $100,000. It's a 180-day bill. Now, a bill is a type of short-term debt. There are bank bills, for example, that we'll be focusing on later. So a bill is a type of short-term debt. And let's just say that the current market yield is 8.75%. Now because that's the market yield, this company will have to pay that interest rate to the people that they are borrowing the money off for a period of 180 days. So what is the issue price of this discount security? Well, it's quite a complex formula here, but don't worry about the formula itself. We're focusing on understanding how these securities work rather than being able to reproduce these sorts of numbers. You wouldn't be expected to do that. But if you plug the relevant numbers into this formula, you get an issue price of the $95,863.45. So the lender will pay the 95 odd thousand, and then in 180 days the lender will get $100,000 back. So the lender's return is $4,136.57 over this initial investment of 95 odd thousand. So short-term debt, discount securities. Okay, the key thing to note on this slide is that the price that is paid for a discount security and its yield is inversely related. So let's just imagine that in the previous slide this bill was sold for $95,863, but then the person that purchased that bill, that is the original lender of the money, wanted to liquidate their position so they could go into the secondary market and sell their bill to another investor. At this point it doesn't really affect the borrower that much. So this bill is sold from the original owner to a new owner, and demand for these bills is low, and the price that is received for the bill in the secondary market is $763.43 less than the original purchase price, so the price of the bill has actually fallen. Now if the price of the bill falls, that means that the new owner will get a higher yield, because the new owner will now get $4,900 profit on this when they redeem it at maturity for $100,000. So the difference between the $95,100 and the $100,000 is sort of the return to this second owner. And that $4,900 return divided by the $95,100 initial investment gives us the percentage return, or the yield, and that yield will actually be much higher than the original yield because the price of the security has fallen. Okay, this is taken from the US Department of Treasury, and it shows the interest rates on different types of short-term debt. So for the 1st of December 2015, we can see that the interest rate on 1 month securities was 0.19%. On 3 month securities it was 0.21, 6 months, and it goes right up to 1 year. Now beyond 1 year we're now talking about the bond market, so that's a little bit different, but I just wanted to show you that these short-term debt markets do have interest rates attached to them, and these are the interest rates on US Treasuries. So short-term debt issued by the US government. Okay, so that is the nature of these short-term debt securities. They are discount securities. So they are sold to a discount of the face value, or sold at a discount to their face value. With long-term debt, we are now entering bond markets. Now, because we're talking about longer term borrowing, maybe 2 years, 3, 7, 10-year borrowing, then investors do need regular interest payments, or what we call coupon payments. You can't sell a bond as a discount security because no one is going to wait 5 or 7 years to get their return. It's just too long to wait. So these are not discount securities. They typically sell, a bond typically sells at its face value, and regular coupon payments are received. So what I've got here is a bit of a timeline, and it shows the cash flow in dollars from the buyer's perspective. So the buyer is going to hand over F dollars to purchase the bond, and that might be $1 million. And this is a 3-year bond. Every 6 months a coupon payment is paid, or it's a type of interest payment to the investor. So if we're dealing with a 5% yield on a $1 million bond, then this coupon payment here would be $25,000. The second coupon payment would be $25,000, so in the first year the total interest payment is $50,000 or 5% of $1 million. So over the next 2 years, $50,000 is paid each year, and then when the bond expires at the end of 3 years, the final coupon payment of $25,000 is paid to the buyer of the bond, and the buyer of the bond will also receive their $1 million back. So these are not discount securities. They do not deliberately sell at a discount. The offer yield of 5% is going to be driven by market forces. So the demand and the supply of money in these bond markets will determine the offer yield or the interest rate in these bond markets. I did say that these are not discount securities, and that's true. However, it is possible that when a $1 million bond goes to market and offers a 5% yield, that investors will demand a higher yield. So let's just say that market conditions on the day that these bonds are being sold into the market have actually deteriorated. People are a little bit worried about the bond market for whatever reason, and they demand a higher interest rate than 5%. How do they get this higher interest rate? Because the coupon of $50,000 is already set. This is happening on the day of sale, remember? Well, the way the market can actually earn or push the yield up over 5% is pay a little bit less for the bond. So instead of paying $1 million, they may pay $998,754. Now this is not, it looks like a discount security, but it's not, because the market could actually pay more than $1 million for this bond if the demand for bonds was very strong, in which case the offer yield would be below 5%. So by actually adjusting the purchase price of the bond, the market can actually push the yield on this bond either above or below the initial offer yield of 5%. Okay, so what we've got here is a very simple formula showing the yield of a bond. The coupon payment is $50,000, and that's fixed over the life of the bond. The price of the bond, just like the other short-term debt instruments that I was talking about, bonds can be traded in the secondary market. So you may purchase a bond for $1 million on the primary market, hold it for a year, and then want to get rid of it. So you may want to liquidate your position and sell the bond in the secondary market. Now, it is possible, depending upon the demand and supply for bonds, that you won't get $1 million. You may get more, or you may get less than $1 million. If you get more than $1 million and bond prices are rising, it means that the new owner of the bond, their yield will be lower. So with bond prices going up, over here the yield goes down. And the opposite is the case. If bond prices are falling, because the coupon payment is fixed, then the yields will be rising.